there is only one Elon Musk on the planet. You could ask him that question because he's got 6 businesses. He was in a presidential campaign. If he's got time, then I don't want to hear anybody else making excuses that they don't have time. It's very rare for somebody to be in real estate and to say that, yeah, I've never lost any money.
It's okay for you not to be investing in the first 3, 6, 12, 18 months.
Welcome back to Peak Profits. Today's guest is Gino Barbaro, investor, business owner, author, and co-founder of Jake and Gino, one of the most respected multifamily education platforms in the industry. Gino has grown his multifamily portfolio to over $100 million in assets under management, co-authored 3 best-selling books, and developed the Buy Right, Manage Right, Finance Right framework that has helped thousands of investors scale their own portfolios. He's also a certified professional coach, devoted family man, and passionate about helping others build businesses that serve both profit and purpose. Gino, legend himself, we are super excited to have you on the show.
Thanks for having me, Brian and Chris. How you guys doing?
We are doing great. We are excited. It feels like a full circle moment. You know, we've both been part of Jake and Gino for 3 years now. And to have you on the podcast that kind of transpired out of all the education that we've learned through coaching and the program is awesome. So we're excited to get into it and learn a little bit more about your background for our listeners and what you have to
I know this is your podcast, but I'm going to ask you guys a couple of questions now, okay? Because I think it's important for the listeners to understand when you first start out, you know nothing. Like you're just drinking from a fire hose. What are a couple of things that you really learned from not only just from the educational platform, but the bumps and bruises that you've taken over the last 3 years? What are some things that stick out? First you, Brian, and then we'll get it over to Chris.
Yeah, I think in the beginning, there's a lot of things you don't know. And I started my journey differently than Chris did, right? I had a couple of my own residential properties, so a 1 unit and a 3 unit. And I thought, hey, this is easy, buy a 10, buy a 50, right? And at the time, I was so naive to understanding that financing was different, property management was different, like everything that goes into the commercial space. And, I tried to figure it out myself. I was online and at this day and age, there's information everywhere, but it's a matter of having it structured and having a coach, right? And so that's when I decided to join Jake and Gino. And honestly, the amount that you can save in time, amount like getting ahead, as well as mistakes by having some mentor that's been far ahead of what you've done is priceless. And so, yeah, the last 3 years, the amount that I know now versus when I reflect back to like maybe February of 2022 has been crazy. And then just even understanding the market, right? The cycles of real estate, which I didn't even realize was quite essentially a thing. I mean, everyone heard of 07 and 08 and 09, right? But I thought, oh, you just buy multifamily and you buy it and you sell it 5 years later and you make a 20% profit. And, so there's just so many lessons that I've learned over the last 3 years of just really diving deep into education and getting into some of these deals myself, which is, I think, laid the roadmap and the foundation for the next 20 to 30 years to come.
Chris, what about you?
Yeah, so as Brian mentioned, like our journeys are completely different. I have never actually owned my own home. I've never owned a multifamily property. I've always been an investor. And that was one of the first things that I learned from the Jake and Gino group was that you don't actually have to be the person operating this in order to receive the same benefits. So being an LP or a limited partner was one of the first things that I really took away from it. And again, prior to joining, I was scrolling through Zillow, like, where am I going to find a house? What markets am I going to look into? I didn't know how to identify a good market versus a bad market. I was living in Manhattan. I'm looking in New Jersey, Connecticut, Long Island, Manhattan itself. So I was really struggling with where do I actually do and manage any of this? And do I even have any of the expertise to do it? And now when I look back, I think the due diligence process is probably one of the biggest things that I've learned around really paying attention to the people who have been there, that have done it, to avoid the same mistakes. There's always risk involved in any investment you ever do, right? Doesn't matter whether it's real estate, stock market, crypto, anything can obviously happen. But I think that due diligence process and realizing that I do not have to be the person who is doing all of the operations was massively eye-opening for me.
Do you mind if I expand upon that answer and just fill in some holes and really, I want to bookend it because what you guys both said is very important. But what you're both really talking about at its core is buy right, finance right, and manage right. That's the 3-step framework. And when most investors start their journey, they don't understand that it's a business. And Chris, you said it very well. You can go in there and you're looking at a property and you don't have to do everything yourself. It's a scalable business. You're not just buying a home or a 10 unit, you're buying a little cash flowing asset. And I think that's what I found out early on was like, I'm trying to do everything myself. I'm going to do this, I'm going to do that. I'm going to ultimately gets burned out. So if you're looking at it from that lens, and Brian, what you had said about the market cycles, it's really interesting. You can always buy real estate. You can buy it anytime. Unfortunately, you can't always sell real estate. And that's what happened back in 2008 and 2009. People cash flowed their deals into foreclosure because their debt came due, asset values were down, but they couldn't sell their properties or refinance their properties. So they went into foreclosure. And that's what's currently happening right now. So if you don't understand the finance aspect of real estate, that's very challenging. The buy aspect is really, really important, right? No deal is better than a bad deal. We can get into the certain criterias, and then you have the manage of what we call the wheelbarrow. That's the wheel of the wheelbarrow. That's in constant motion. But what I think would be really cool is if we can dive into what Chris said with the LP, because I think LPs, it can be such a powerful tool, because even if you are an active investor, like say for myself, I should still have the ability to go out and do deals passively. I don't have to be active in every single venture. I can be a business owner, own a business, make a lot of money with my business. The whole goal is to take your earned income, whether it's from a W-2 or whether it's from a business, and put that into a vehicle that can ultimately create some type of passive income. That's what the goal is. That wasn't the goal 30 or 40 years ago when I was growing up, because wages were better. I mean, like, you could live. My father had a restaurant back in the 70s and 80s. There were 4 families. We had a great upper class, light middle class income. He was driving a powder blue Eldorado. We were doing really well. The 2000s come, everything changes. Yep. I mean, in '08, I was talking to somebody who was a recruiter, and he said '08 was really the time when people started doing these side hustles because the economy crashed. There was not enough money. The jobs weren't there. So that's when everyone started jumping on bigger pockets. That's when Jake and Gino actually got together in '09, because I had 4 kids at the time. I've got 6 now. I wasn't making enough money. So if you're out there and you are a tech worker, you're working in sales, you're a high-level entrepreneur, you don't have the time to do this business, well, Brian and Chris have a fund. And if you can't do it, they can invest your money. But not only them, there's so many other operators out there. You don't have to do the business. And I think what would serve the listeners is if we can jump into, if I'm an LP here, sitting here, how do I do that? How do I vet a deal? How do I look at a multifamily and say, this is the right deal for me?
Yeah, that's exactly it. And to add on to that initial question is what is so important is when you're buying a piece of property, right? That initial finance, right? So it's like, what's your exit plan? Have an exit plan going in, or having multiple exit plans to understand that, right? And sometimes it's easier said than done, right? Because you don't understand some of the market. People didn't see '07, '08, '09 coming, but there's a lot of people in hot water right now because of what they bought in 21 or 22 with the rates the way they were and cap rates being super compressed. But to your point, yes, to elaborate on that, to be an LP and to understand how to make your money work for you into some of these assets. We talk with people every single week that are interested in diversifying into real estate. And most people, one, don't even realize that they can invest into commercial real estate in this capacity. And then they think, I need to go out and buy residential real estate. I need to buy single family. The numbers don't work. It won't cash flow at 7% interest rates. The property itself is too expensive. And so it's really the start of the education saying, hey, these opportunities are out there where you could be a limited partner in a larger deal that's run by a professional operator, right? And then it's starting that due diligence process from there and understanding what that investment looks like. And, to go back, that's kind of what you and Jake got started in. What was it, back in 2012 after the restaurant where you guys started and you got your first property in Knoxville, I believe.
Yes. Yeah. And it's interesting what you're saying, everything you're saying. And what's pretty cool is 3 years ago, I can bet $1 million you didn't know what cap rate compression was. I can just tell you right now.
I didn't know anything about a cap rate.
Okay, I can bet another $1 million you didn't know what an exit strategy was. No. Another $1 million. I can bet another $1 million that you didn't know what the 3 pillars of real estate or market cycles were. These are all things that new investors don't know, and they're trying to buy their first deal. So why would you do that? For me, I think learning while you're earning is phenomenal. Even if you want to do the business full time and you're a doctor or you're a lawyer and all of a sudden you're overwhelmed, your job is killing you, I would go out and find somebody who's syndicating deals. And we're going to go through this 3-step framework disclaimer because I think it's important. But you can put 50,000 or 100,000 into a deal, invest passively in that deal, and understand how the deal works, understand the team members, understand the market, understand the asset class, understand all of that. But before anybody does any of that, guys, I'd like to talk about why real estate, why multifamily, but more importantly, if you're listening to this, what are your goals? It's one thing to say multifamily is one of the best vehicles. I personally think it is. It's a basic human need. It's got amazing benefits. I'm sure you've gone over it. But before you do that, I think you need to understand, why are you investing the money? Why are you pulling it out of here to go into there? I personally think the stock market is one of the biggest Ponzi schemes ever. I'm just not a big fan of it. I think it's overvalued right now. But as we were talking offline, where else is an investor going to put their money? Most other countries are not doing well, so they keep putting money into the stock market. I don't feel as if I have control with my money in the stock market. That's why I love multifamily. I love the tax benefits of multifamily. I love the control. It's really a business. It's, if you understand income and expenses and you know how to add value to these properties, it can make you super wealthy. And once again, like I said, it's a basic human need. So before we start putting any money into these deals, if you're listening to this right now, what are your goals? What are you trying to accomplish? Are you trying to look for some kind of passive income to pay some bills? That's what I was doing early on. That's why I got in with Jake. I never thought I would be able to leave the restaurant. I'm like, hey, I've got 4 kids. I've got these bills coming up. I'll take some money from the restaurant profits, put them into a multifamily, cash flow here. That's all I really wanted in the beginning. Ultimately, I said, hey, I can leave my business. Do you ultimately want to leave your W-2 and go into this full time? Or do you just want to continue to save for retirement? There's a lot of different questions. You need to be clear on that before you go out and you start investing in deals. But I think ultimately everybody should start or could start as a passive investor with a $25,000 or a $50,000 investment, putting it into an asset and saying, yeah, I'm going to see how this asset works, getting a sponsor that is very communicative, that maybe will give you, a little, I don't want to say a little bit of mentorship, but it'll give you the webinars, possibly a property tour. So you get an idea. And as you're doing that, you're learning while you're earning.
Yeah, I would absolutely agree with that. And I remember back to one of the first lessons that we had with you, Gino, and it was all about what is your why? And it was what everyone will say is, I want to earn passive income. And I guarantee the first number that comes out of everybody's head is 10 grand a month. Like, it was the first words that came out of my mouth. Yep, I want 10 grand a month. But why? Like, what is actually underneath that? And it's almost, I think we were sat in a room and you just kept asking everybody why. And then everyone would go a level deeper, but why? Another level deeper, but why again? And before you know it, you've got people in their tears, and people really start to understand truly, why are we actually trying to do this? And I think it really does help shape what your goals are with the investments beyond, I want 10 grand a month in passive income, which sure, I think everyone would be pretty happy with 10 grand a month of passive income, but it's really the level below that. So that was really, really helpful for me. And the other thing I did want to share is the value of putting money into your own education.
Oh, yeah.
As somebody who, I didn't go to college. So I left high school, I went straight into my career, and I was like, okay, so maybe nowadays people look back at that and go, well, that's what a lot of people are doing. But back then it was a completely different path. It was really going against the grain. The investment I made in the education that I've learned through the Jake and Gino program, to your point, I had no idea what a cap rate was. I had no idea what NOI was, right? And again, it's really not that hard.
It's not. Yeah,
it's not
right.
rocket. It's not rocket science, but you just don't know. Like you said, it's a business. Income minus expenses, and if you can increase the income of that property, then you can ultimately increase your business value. So those are like some of really the fundamentals of just like, we're just breaking this down. It is really just a game of math. It's not that difficult. Now, obviously, the operational side of it is a lot harder than I'm making it sound right now. But just on the surface of it, those were some of the things that just immediately clicked into my head, and I was like, wow, this is a powerful vehicle. And that's really when we dove into the education a lot.
Chris, I'd like to expand on that as well. When you're talking about getting into it and why you're getting into it, we had talked off camera as well, my new venture. I'm becoming a money coach. If you want to learn more, go to barbaro360.com. But what I love about money coaching is, as you're listening to this, I want you all to understand you have a certain relationship with money, right? And we all view money differently. And when I say the word money, there's just an emotion to it. Now, early on, I had the scarcity mindset with money. I had fear built around money. I had anxiety built around money. I was the saver around money. That's how I was raised. I had two immigrant parents. So for me, saving, 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 and not enjoying, that was my relationship with money. And as I started to buy assets, I started to build a portfolio. My relationship with money didn't get that much better until I came to a certain point where I'm like, okay, what did I hear in the past about money? And more importantly, are these patterns and these beliefs that I had back then that I have 5-6 years ago, am I passing them on to my kids? I was like, holy crap. I mean, I was giving anxiety to my kids about money because they're always around. They're always listening. You know, whether you talk about money or whether you don't, your kid's still here. You're avoiding the topic. They're going to know you're avoiding the topic. You're going to have a child who grows up. Now, what's the point of mentioning a relationship with money? It's because when you're going out and you're investing your money, people have beliefs about money. Have you ever heard it takes money to make money? Money doesn't grow on trees, right? All of these things. And where do you hear these from? I mean, unfortunately, most of the patterns that we have with money are really inherited from our parents. I mean, if you go into the inner cities, why are they poor? No matter how much money we pour into it, it's not the money that's going to solve the problem. It's the patterns that we have, right? And it's also, if you're looking at it from that perspective, you're looking at it for yourself. Go back into the past and hear what's going on. Hear the things that you heard. Do a little money bio for yourself. What did you hear when you were growing up? And bring it to the present and see how you are with money right now. See what emotions come up. Because some of us, you know, when you hear the word fool, we talk about archetypes in money coaching. A fool is an archetype is a character within inside of you. A fool is a person who likes to gamble, who's an optimist. Well, if you're a fool, you're driven by dopamine, maybe you should pull back and say, you know, maybe I shouldn't invest in multifamily. I shouldn't be investing right now. Understand what that relationship is before you take that next step, because that's important, because a lot of these beliefs are going to hold you back. We were investing for 5 years before I even did my first syndication. My limiting belief was, I can't take investors' money. I don't want to lose their money, but I mean, I may lose my money. So what's the difference? My money, their money, it's still the same, but that was my block, right? And my block was it takes money to make money. But then all of a sudden I did a couple of syndications and that belief was completely shattered. So as you're listening to this, you may have a ton of beliefs. You may be saying to yourself, I can't invest in apartments. That's for like the big REITs and the big hedge funds. That's your belief. That's your relationship with money. And I'm not here to tell you you're right or wrong, because if you do believe that, and that's the way you process things, it's going to be the truth for you, no matter what I tell you here.
Yeah. No, that's spot on. And I think a lot of our listeners are high earners that do very well for themselves in their profession, you know, whether that be in tech sales, you know, doctors, lawyers, people that maybe have bought a residential property, one or two, maybe have a small portfolio, but they're exploring. But that goes back to your point about patterns, right? You could be making $300,000, $400,000, $500,000 a year. Are you spending $300,000, $400,000, $500,000 a year? You know, are you investing it? Are you using that money that you're earning as a lever to compound that,
Yes.
right? To use it, because to your point, like your mindset early was scarcity. Let me save. Let me just try to bundle up cash and, you know, save, right? Versus using this as a lever to really escalate and compound, you know, the ability to do so. And you talked about really that passive investment framework, right? And what that looks like for people that are potentially exploring the opportunities and the avenues to invest, you know, passively to start and to learn and to educate and to get into a deal, right? And to see behind the scenes or under the hood of what's happening. Can you dive deeper a little bit into what you mean by that and what that looks like?
Sure, I would love to. You've selected multifamily or even mobile home parks. I think this framework works whether you're doing a real estate deal and or you're buying a business, because I'll show you the business aspect of it. When you're investing passively, you still need to understand the business itself. You're going to be giving your money to somebody to invest that money for you, but you still need to understand the underwriting aspect of it and all. What most investors do wrong when they look to invest as a passive investor, they're looking for the deal. I need to find a deal. I need to find an IRR of 20 plus. They're doing it backwards. When you're investing passively, the first thing you should be looking at is the sponsor, or what we call the jockey, right? The jockey is the guy who sits on the horse, the first step. If you like the sponsor, if the sponsor's been doing the business for a while, if they've been growing NOI, if they have a sound business plan, right? If you understand the business plan, if you like their team that they've assembled, if you look at their portfolio and you like what their portfolio is, how it's performing, and you think they're a great sponsorship team, the next step after you vetted the GP, the sponsors, you like them, is what we call the alignment of interests or the saddle. right? The sponsor has to sit on a saddle. Those alignment of interests are important because now if I'm the limited partner and I'm going to be investing with you two as the general partners, our interests have to align. It can't be a one-way street. You guys can't be charging me too much fees, okay? I have to look at the fees and say, hey, if I make my returns, you guys are going to make your returns. If I'm looking to get out of an asset in 2 years, but you guys are saying 5 to 7 years, interests aren't aligned, right? Really, really important. There's a lot of other metrics when you're looking at as far as alignment of interests. I'm trying to think of a couple more. For me, when it comes to alignment of interests, if I've only got $32,000 left to my name and you guys are saying, hey, real estate, no risk, guaranteed, probably interests don't align there too well. You see what I'm saying? So, I mean, like, and the other thing is my risk tolerance, is my relationship with money going to make me sleep at night if I give the GPs my money? That's another alignment of interest. Like, am I okay to take that risk? Understanding that. Now, if our interests align, you guys have a solid business plan. I like the fees that you guys are going to charge me. You're not overcharging me. You're going to work really hard. Those two are satisfied. The third one is the horse that the jockey is sitting on. The horse is the deal itself. And now you can say, oh, now let me look for the deal, right? Because the sponsor, you've already selected a niche, right? You've selected self-storage. So let's say you're in self-storage. You're going to look for sponsors in self-storage. Then your interests have to align. Now it's like the buy right, the manage right, the finance right. That's the horse. That's the deal. That's the order that you should be doing as a limited partner. Now, if you want to dive into it just a little bit more, what I would say is the sponsorship team is everything. I would vet every single person on the sponsorship team, whether it's their CPA, their cost segregation specialist, their syndication attorney, their property management company, their asset management company. Every sponsor on that team, I want to see who's on that team. The mistake that I made back in 2005 when I invested with the sponsor, I gave him my money. I never went down to the property. I didn't know what due diligence was. Chris, what you said, I didn't understand any of that. I would also take it a step further. If I'm going to invest $50,000 or $100,000 into a property, I want to have myself fly out to that property, spend $600 on a flight, get a hotel room for the night. I want to meet the property management or possibly the sponsorship group. And or if they're not going to meet, I want to walk that property. I want to walk the area. I want to feel it. Because when I bought that property in 2005 and I gave my buddy Maserati Mike 172 grand, I never went to the properties. I never did due diligence. When I went online to see what the properties were, median incomes were horrific. The mobile home parks were drug infested. Now, I'm going to blame Mike because he is a dirtbag and he's negligent. He's a fraudster. But I can't blame Mike because I'm the one who wrote the check. I'm the one who never got on a plane. A person with money meets a person with experience. The person with the experience gets the money, and the person with the money gets the experience. And that's what happened to me. So that's why I think this framework is so important. People say, well, you know what? I don't have time to go out there. Well, you're writing $50,000 or $100,000 into a deal, especially if it's your first or second investment. I'm telling you, I just think it's important. Go out there, fly out to the property, do a property tour, walk a couple of properties, and maybe, hey, meet a couple of realtors in that market and do some property tours. Talk to the property management companies out there. Ask for this property that you're investing in. What do you think about this ABC property management company? And have you heard anything about the asset management company as well? You're doing a deep dive into the operations of this asset because once again, you're not just buying a bunch of buildings. You're buying a business with people who are running it and have specific skill sets to be able to run that business.
Yeah, that's an incredible overview there, Gino. I think really to bring it all the way back to one of the first things that you said is people go about it the wrong way. They look almost, they're chasing that shiny object. Oh, I'm going to 3x my money. That's exactly what I want versus a deal that might be 1.7x my money over 5 years. But the 3x doesn't necessarily mean it's guaranteed to get there, right? And again, I think that was another early lesson. I remember the Maserati Mike story very, very well. I knew that was going to come up in this conversation today. So how, if beyond like going down to the property and things like that, I always believe asking some of the more difficult questions that maybe even make you feel somewhat uncomfortable asking the sponsor is a great way to test the sponsorship team as well. Because if you're feeling uncomfortable asking the question, it's probably a very difficult question for them also to answer back to you. But you are investing your hard-earned money into one of these properties. You should be able to ask any question. It doesn't matter how hard, how easy that question ultimately is. So I always find asking a really, really difficult question that's very, very hard for yourself to even ask. Not, I don't mean you don't know what the answer is, you don't know the question you should be asking, but almost a very personal, very detailed question of whether you've reviewed the underwriting, right? What they believe the market comps might be, and really trying to stress test some of that due diligence that they've done that you've done as well.
Chris, what I would say is if you're an LP, and I'll take, for instance, you two guys come to me and start having a conversation. If you're not asking me what my goals are, if you're not asking me my liquidity, if you're not asking me about my risk tolerance, if you're not asking me about have I invested in this asset, really getting to know me as the LP, I, as the LP, should probably walk away from you two because you really don't really care about me. You just care about the money that I'm investing in. So you need to get, as a general partner, as a sponsor, you need to make sure that I'm a good fit for you as well. And I think most sponsorship groups, they just want to raise money, and that's the goal. They need the money, so they don't stop and think, and they only think of it as transactional instead of trying to really look at it as a relationship. So that's what I would want as a limited partner. I want you guys to know about my goals, about what I'm trying to accomplish. And as for me, I'm always going to ask the question, when was the last time you lost money? And it's very rare for somebody to be in real estate and to say that, yeah, I've never lost any money. I find it funny when people say that Trump's gone bankrupt 4 or 5 times. If you're a billionaire, you are going to lose money. You're going to lose money in real estate deals. You're going to lose money in business deals. That's part of life. You make mistakes and you learn. Now, for Jake, he was really lucky because there's life before Jake and life after Jake. I made all of the mistakes before I met Jake. Then this guy comes along. I jumped into mentorship. I learned the business. In 2011, we get together, and in 2013, we buy our first deal, and we came up with the framework. Since then, we haven't had a deal that's lost money. So I think he's the only investor in real estate that has never lost money in real estate. And it's funny, but it's the damn truth. I'm like, damn. I mean, like, but that's the question you should be asking. When was the last time, or what deal did you lose money on? And also, what's your communication style? How many times am I going to hear about this deal? And are you going to tell me that we're losing money, 6 months after the fact? Or are you going to be really communicative with me? Or am I able to get on and ask you questions? Because that's important. Now, if somebody who's got 50 deals, that may be a little bit more challenging, but there's a lot of sponsors who have teams and who have investor relations and all. So I want a sponsor who's going to be really communicative with me. I want a sponsor who's going to be honest with me. And I want a sponsor who actually looks at the business and can give me some metrics, not how much they've sold. Because you guys know with cap rate compression, you could have sold the property in the last 3 years and made money without growing the NOI at all. I want to know what you've done in your properties. Have you grown NOI on properties? Or have you just been lucky that you bought properties cheap and you sold them for a little bit more because cap rates compressed?
Yeah, I laugh because you're talking about Jake and kind of what you guys have built and the lessons I guess you went through prior to the partnership, right? And every time you tell the story about Maserati Mike or going back to, those old, you could tell it still like infuriates you about the lessons that you learned back then. And then, obviously what you and Jake have built since 2013 in your first deal, you probably couldn't even imagine in your wildest dreams to have this massive portfolio that you guys own today and kind of what it's grown into. You talk about just wanting cash flow in the beginning and never leaving the restaurant, just a little bit of extra cash flow. And now you have this like sprawling business, multiple books and everything else. But so on that, going back to one of your points is if you're investing into a deal, it's a true partnership for 5, 7, sometimes 10 years, right? So you want to make sure you're doing your due diligence and understanding who you're partnering with, because many times you see people either JV, even on a smaller deal, that get into partnerships and 5 years down the road, the relationship is much different than it was when they first got in. And they're just so anxious to get into a deal. So I think doing that due diligence, to your point, no deal is better than a bad deal, is super important. And then the conveyor belt theory, right? When you're talking about investing, if you were an investor in our shoes right now in 2025, maybe a listener right now that has cash in the bank, right? That wants to diversify, has a large stock portfolio, but is really on the fence now about, hey, I think I want to get into real estate. I think this is my strategy that I want to start dipping into for the next 10 to 15, 20 years. What advice would you give? What is the conveyor belt theory one that you teach in your program? And then what advice would you give someone starting out that, has capital to place and they've done their due diligence, but now they're looking for a strategy?
It's interesting that you say that. I heard the slogan 3, 4, 5 years ago that cash is trash. That's what we heard. And now people are hoping that, they have dry powder. And it's really cool because I think right now, since 2022, a lot of the real estate markets are down 20, 25%. I think with this interest rates, it's very interesting. Interest rates are not dropping. And I think that's putting more pressure on real estate and real estate assets to continue to drop in price. So if you're looking to invest right now, I would say the first thing is go online and just Google multifamily syndicators. Just go out and try to get as many syndication groups as you possibly can. Start opting into their emails. I mean, where can they find out about you guys? What's your website? Where can they go?
7pcapital.com, right? There's
So that's what I would do. I would go to 7pcapital.com. I would contact you two. I would get on your mailing list. I want to see the offerings that you have coming out. I want to see the content that you have coming out. That's the first thing that I would do. That before that, I would just say, I'm just starting out. If I'm just starting out, let me pick one niche, one vehicle. Let me either, whether it's mobile home parks, whether it's self-storage, whether it's multifamily, maybe it's single family portfolios of homes, whatever that is, just pick one. And then learn the buy right, the manage right, the financial, learn how to underwrite a deal, right? That's important. But then from there, like I said, start opting into lists, start talking to other sponsors, other sponsorship groups, start going to events as well. That's the important thing. Go to events and start talking to people who are on stage, who are talking, start talking to people who are in the crowd as well. And then the other thing I would do is, as a limited partner, you can really go nationwide. You can invest in any part of the country. What I would do early on is I try to really understand a couple of cities, a couple of markets, become an expert in a couple of markets and find some sponsors in those markets, because then you can understand the income, the expenses, how to underwrite a deal in that market, what looks good for a deal, what doesn't look good for a deal. And then honestly, what I would do, this may sound crazy, but if I'm just starting out, I would go out and I would really hire a coach or hire somebody, a mentor, just if I'm a limited partner, just to have them underwrite the deal and give me a fresh set of eyes and let them poke holes in the deal. I don't know how many students we've saved over the years from having them look at deals from our coaches, and the coaches saying, ask this question, ask that question. Median income is too low. Rent growth is too high there. Expenses are not enough expenses. They're not going to be able to refi after year 3, whatever the case may be. Like, you need to have a separate, fresh set of eyes. Spend a few $100 on somebody who can help you look at under. AI is great. I don't trust AI fully right now. And when you're starting out, there's too many nuances to the business. So, if I could recap it, I'd say pick the niche, then go out, pick a couple of markets, then go out, find a couple of sponsors in that market, learn the business, start getting some deal flow, start getting some deals from these sponsors that you like, then start looking at the underwriting of the deal. And then from there, if that underwriting looks good, then obviously the next step for me would be to do my due diligence, get in a plane and start looking at those assets.
I'm laughing because I can think back to a property that both Brian and I were thinking of investing in, and we were like, let's just run this buyout coach in Jake and Gino, Bill. And we got on a call with Bill, and we were like, Bill, we think we've got one. Like, we were both so excited, sat there, and he just went, what about this? What about this? What about this? And we both just looked at each other and we were like, I don't think we should invest in that deal almost instantly. And we were so excited. We were so excited. We were like, we finally got one that want to invest from when we had joined the group. Like, you do get hungry, right? You do want to get that first deal. And I think it again, one of the things is no deal is better than a bad deal. So take your time. It's okay. There are going to be deals. There's always going to be another deal, right? It's okay for you not to be investing in the first 3, 6, 12, 18 months. The number of months is almost.
That's right. That's right. You guys are young enough that you have like the next 30, 35 years. You have like another 3 or 4 at least market cycles to go. And that's why, I'm sorry, but Brian had mentioned about the conveyor belt. So this is important for a limited partner. If you've got a ton of capital right now, you've got $1 million, $2 million, $300,000, whatever it is, you don't have to put all that money into one deal. If it was me, I would spread that deal out, because that's one cool thing about investing as a limited partner. You can diversify into different assets, into different markets, into different sponsors, into different asset classes, into different median incomes. So if you have $300,000, maybe you put $100,000 into 3 different deals and spread out the timeline so they don't all matriculate or they don't all come due in year 5, where you may have a big tax consequence. So maybe you put $100,000 this year, $100,000 next year, and $100,000 the following year, and you spread them out and you give yourself some time. So by year 5, the first deal is coming off what we call that imaginary conveyor belt. Year 6, that second deal is coming off, and year 7, that third deal is coming off. So it gives you a little bit of time. And I think that's the problem. I think we get so hung up, and what we estimate we can do in a year, we overestimate it tremendously, but we vastly underestimate what we can do in 5 years. Because real quick, 2011, Jake and I got together. It took us 18 months to find the first deal. We bought that first deal in 2013. By 2015, we had a little over 400 units. So it took us 4 years to get 400 units, but the first 18 months we were sucking wind. So that's really, really challenging, because then you start figuring it out. You're like, oh, I just did my first LP investment. I saw how that worked. I went online. I found sponsors. It was a little bit hard. I didn't know the underwriting. But when you get that next opportunity, things move a little bit quicker. And then you get that next opportunity and things move even quicker. So give yourself some time. You didn't come out of the womb a multifamily underwriter. It takes a little bit of time to figure it out. It's the reality. Like, we beat ourselves up. Just love yourself a little bit. It's okay. I mean, I am a tyrant to myself as well. I'm really good at this, like, self-worth. Sometimes I suck. I can't find a deal. It'll be okay. The deals will come. Don't beat yourself up, because at the end of the day, I personally think that we're all out here winging it and trying to figure it out day by day.
Yeah, that's so true, right? And that's why I think, going back to your old point, it's so important to surround yourself with people that are doing what you want to be doing, and maybe are ahead of you, or a mentor. And going back to your last point that you mentioned just a few minutes ago, is even if you're an LP looking to hire a coach just for guidance, right? Because Chris and I, we have 30 more years of investing in real estate. I have a portfolio of my own properties. I've invested in numerous commercial properties and multifamily deals. And, you learn a little bit of something on each deal, on each property. And, something goes right, something goes wrong, or, and
Yep.
so to really expand your knowledge, right? You'll never know everything, but there's so much you can learn from reading and getting surrounded by the right people and the right network. To your point again, is going to events, like the events that we've gone to with Jake and Gino, and just getting in a room with 50 people and 100 people that are talking the same language or have different, experiences in different markets. It's gone such a long way as well. And, that's super helpful with the educational piece. So with all the experience, I guess, you and Jake have had now over the last 12 years, where do you see, where we're at right now in 2025 in this cycle, kind of how it transpires? I mean, obviously you don't have a crystal ball, right? I wish we did. I wish we could buy the perfect deals and sell them all in 2030 or 2032 for these massive gains. But you've been through cycles. You've understood it now, from Maserati Mike in 2005 to buying your first deal in 2013 to now here we are with this. You have this great portfolio for yourself in 2025. Where do you feel like we're at now within this market, and where it kind of heads from here?
Well, we were hearing survive till 25. Now it's thrive from 26. I don't know. It starts changing. And it's really interesting. That's why, as you're doing this, don't beat yourself up, because the so-called experts, the conventional wisdom, they've been wrong for the last 4 years. It's very hard to estimate it. We had inflation that was supposed to be transitory. Then it didn't end. Now it seems like it's ending. Tariffs were supposed to kill the world, the business. It's hard to answer because there's so many things that can go on geopolitically. My whole thing is that you have to have a longer term mindset. And that's the thing. You can't think of buying a deal and, hey, within 2 years, you can exit. That was the business market cycle of 2019, 2020, and 21. That's when things were really hot. You could buy a deal and flip it in 18 months. That's not happening right now. Now you're buying deals with the expectation of holding them at least 3 to 5 years, a 5-year time horizon. Now's the time where you're going out there. Debt is pulling back. So it's a little bit harder to finance these things. And even in residential is having a lot of deals fall apart because of the appraisals going on. So this may be back to like the 2011, 2012 era where there's not as much deal flow. And I'm hoping in the next 12 months, they drop rates. I'm hoping that'll spur some people to sell their properties, because they know right now they bought their property for $2 million 2 years ago at 3.5%. It's not worth $2 million at 7%. It's just not. If they don't have to sell, they won't. And a lot of people aren't selling because they can't. They won't hit their price. So until we see some kind of interest rate move, or we see some kind of, what's the word? When people get really distressed, the stress has worked itself out. I think, to me, the conspiracy of what the Fed is doing is they're just not trying to drop rates because they're not trying to save operators. They want deals to fall. They want deals to go into foreclosure. They don't want to save anybody. That's what I think, right? Because they could have dropped them 2 years ago. A lot of people with those bridge debt deals, they would have been saved. But that wouldn't have been good for the real estate market because you're rewarding really bad operations. And who gets hurt? You know who gets hurt? The residents get hurt because they have a crappy product. So they lost a lot of LP capital was burned. It was just completely dissolved. So I think right now going forward, I personally think in the next 2 to 3 years, there's going to be a buying opportunity, especially in certain markets where you have a lot of deals coming online, like the Dallas market, a lot of this stuff where all of a sudden you have this supply. As the supply burns off, get into the market now because when the supply burns off, you're going to see demand pick up and asset prices are going to continue to rise.
That, again, every time you speak, Gino, I sit there and I'm like, I'm learning something constantly. I want to switch gears slightly. We spoke about the money aspect. We've spoken now about real estate, the buy right, manage right. We've spoken about the conveyor belt theory. We've spoken a little bit about the market. How do you, and I want you to share this because you owned a restaurant, you were raising a family, you started to invest, you had a lot going on, which a lot of people listening to this have also got a lot going on. Life is always busy, right? It doesn't really matter at what point in time in your life, there's always going to be something, it's always going to be busy. How did you balance all of that? Did you have a framework in place? Did you fly by the seat of your pants? I'm sure the answer to that is yes, sometimes, right? Like, how did you balance all of that? And what advice would you give to people that are in a similar position where they're raising families, they've got a full-time job, maybe they're looking to operate their own real estate, multifamily business, maybe they're looking to be an LP? Like, what would you share for those people?
Well, there is only one Elon Musk on the planet. You could ask him that question because he's got 6 businesses. He was in a presidential campaign. If he's got time, then I don't want to hear anybody else making excuses that they don't have time. They're just not crystal clear on what their values are. They're not crystal clear on what they're trying to accomplish. Elon's trying to save humanity, right? That's his goal. He's trying to get people to Mars. He's got a boring company. He's got a solar company. He's got an electric vehicle company. You can see clearly what his values are. And he'll sleep on the floor of his warehouse manufacturing. He has a crappy house. He doesn't care about money, but he knows what his values are. He's really aligned. So for me, my values were family. My values were wanting to build a business and wanting to leave a legacy to my kids. That's what my values were. So unfortunately, I had to give up a lot of stuff. I couldn't sit around Sundays watching 8 hours of football. I never could play golf on Sundays because that was the day that I could spend time with the family. So I was really dialed into what I wanted to do. So if you're talking about a framework, the framework is values-based decision-making. You get your values, you line them out, you see what's truly important for you. If it is truly important to have money saved and to have some type of financial foundation, you're going to figure out time to spend doing that. I forgot what Tony Robbins said. He said it's something very similar to this. Show me what a person, where they spend their time, and I'll show you what they value, right? That's truly important. I spent my time on building the business, building the portfolio, building Jake and Gino because I loved coaching, I loved teaching, and I loved having my family involved in that. That's where my values were. And that's why I was able to accomplish so much because I was really crystal clear on what my goals were. See, we don't lack the motivation, we lack the clarity if we're clear on what those goals are. So for you listening out there right now, what are your values? What are you trying to accomplish? That's important. I mean, for me, having financial stability, having wealth created is so important for me because I had that one restaurant. I could have gotten hurt. I could have gone out of business. COVID would have put me out of business. I was still in New York. So I knew these things. So for me, the values of being responsible, having control in my life, I was not going to let that happen to me. So I dedicated the time necessary to be able to build what I built to avoid that and to live in alignment with my values. And I'll challenge anybody out there. When you're not feeling great or you think you've made a mistake, you've probably made a decision that's not incongruent with what your values are. The Maserati Mike, totally not in my values alignment. That guy was not a good partner for me. We did not align in any way. In 2015 and 16, when I moved here, I met a couple of guys. We wanted to build some Airbnbs and some vacation rentals. One guy was phenomenal. The other 2 guys, not so. And the values alignment wasn't there with those other two partners. The business model was phenomenal. We could have really done really well, but they weren't the right guys. And I sort of knew it. It was part of my fault because I didn't have the core values. I didn't have the cadence of accountability. I didn't have the expectations set up. But at the same time, the values weren't there. And that partnership didn't work because of that. So once again, think about what the values are, understand what they are, and make your decisions and your goals and your objectives based on your values.
And I think that's super powerful. And I think it speaks volumes to who you are and what you've put together. And you guys wonder why we hired Gino in his program as a coach. I mean, it's been a game changer for the last 3 years. And we're super excited to have you on. And the amount of knowledge that you've shared on this podcast with us is the fact that this stuff is free. Like, this guy's time is valuable here, people. Right? He's running multiple businesses. But Gino, to wrap it up, I mean, thank you for coming on the podcast. You shared a ton of valuable information, content, tricks, tips, and everything that people can learn from, right? And so where can people find you, your money coach, everything that you're doing now, and reach out to you and your community?
Just go to barbaro360.com or go to jakeandgino.com. And if you want a copy of our new book, Happy Money, Happy Family, Happy Legacy, just email me, gino@jakeandgino.com, and I'll send you a free PDF copy.
Oh yeah, I'll be sending you an email after this too.
Yeah,
thanks, boy. You got it.
Yeah, I got the other one. I got I think I got 3 of your books over there: the wheelbarrow, and then the honeybee. And I love it. Yep, I think Chris. Yep, there he goes. You got the honeybee now.
Yeah, that's a great book.
Yeah, absolutely.
Great book.
They're all great books. They really are. So, yeah, you mentioned that before we jumped on that you would give some people a few pieces of collateral or books that they should go ahead and read. I'm going to put you on the spot now.
Oh,
what would you recommend people read?
That's a great question. Depending on what you're trying to accomplish, if it's real estate, there's so many books out there as far as real estate goes. I mean, if you're starting out, just jump on the Bigger Pockets website. They probably have a lot of stuff for LPs, a lot of stuff for general partners. Company called Cashflow Portal, another great company that has resources to go on as well. If you're looking for books to read, there's so many amazing authors, so many amazing books that came out. But I mean, as far as classics, I would stick to Stephen Covey. I love Stephen Covey. I love Napoleon Hill. I love Zig Ziglar. Those are the old classics that seems as if a lot of the newer, influencers are just taking stuff from the old guys. So I love those. Those are timeless classics.
That's amazing. All right. Well, Gino, thank you so much. This has been incredible. We really, really do appreciate your time. And everyone should go and definitely go to Barbaro 360. That's Gino has been an incredible mentor. I know he has for myself and for Brian as well. So everyone should definitely give it up for Gino and go and give the guy a visit. So thank you so much, Gino. Really do appreciate your time.
Thanks, guys.
Thanks, Gino.